Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Brookfield Asset Management stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Brookfield Asset Management is an asset management company. An asset management company invests pooled funds from clients into a variety of securities and assets. BAM focuses on real estate, renewable power, infrastructure, and private equity. The company's headquarters are in Toronto. It also has offices in New York City, London, Rio, and Sydney. The company began trading on the Toronto Stock Exchange in 1997 and the New York Stock Exchange in the year 2000. The ticker trades on the Toronto Stock Exchange. The ticker symbol is BAM-A. We're going to look at the ticker that trades on the New York Stock Exchange. The ticker is BAM. Let's get started with the model. This is a large cap company, 63 billion market cap. They're trading at $42 a share, and they have 1.5 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive and growing free cash flow each year from 2.3 billion to 3.3 billion. They didn't report their 2020 free cash flow, so I used 2019 number. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have positive net income. It's a lot lower in 2020. It peaked in 2018 at 7.5 billion. Revenue is the sales for the company, and that grew a lot from 2017 to 2019, dropped a little in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Their main cost is the cost of their employees, the payroll. Below that is gross profit, which is a difference between revenue and cost of revenue. And that did peak in 2020 at 15.4 billion. Below that is operating expenses. Examples are marketing, depreciation, and insurance. Below that is operating income, which peaked in 2019 at 10.2 billion. It was pretty high in 2020 at 9.6 billion, even with lower revenue. Below that is the interest they pay in their debt, and that was 7.2 billion in 2020, which was similar to 2019. Below that is operating expenses, which are usually impairments or other non-operational gains and losses. Below that is pre-tax income, then their taxes. They did have low net income in 2020, mainly because of the negative in other income and expenses, and in prior years they had a big positive. I would focus on operating income when looking at the income statement. That gives you a better indicator of a company's operational business. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. If the company buys a new office building, the cost of that building goes into CapEx the first year it buys it. Then the cost of the building is depreciated over time onto its income statement. Operating cash flow minus CapEx gives you your free cash flow. And the company has a lot of free cash flow each year, between $2.3 and $3.3 billion. Free cash flow is the cash that's remaining to pay a dividend, and this company pays a dividend each year. Even though the company has positive free cash flow, it looks like it's adding debt each year. It added $20 million in 2018 and added another $20 million in 2019. When a company adds this much debt, it's probably using the debt to acquire other businesses. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And to calculate operating cash flow, you start with net income. Then you have to add or subtract the non-cash items on the income statement. They pass through a $4.9 billion depreciation expense. That brings down their net income $4.9 billion, but it doesn't affect cash flow, so we add it back here. They also passed through $800 million asset impairment. An asset impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. They also had negative $1 billion in changes in working capital. Even though they reported a $5.4 billion profit, they actually generated $6.3 billion of cash flow. In 2017 and 18, they generated less cash flow than profit, mainly because of the other non-cash items they passed through, negative $2.7 billion and negative $1.6 billion. We would need to dig into their financials to figure out what these dollar amounts represent. Let's look at the capital structure. $35 billion of equity, $148 billion of debt. They're 19% equity, 81% debt. And their net debt is $138 billion. Their WACC is 9.5%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $62 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $54 billion. We divide that by 1.5 billion shares. And we get a calculated stock price of $36. They're trading at $42, so they're trading at a 16% premium. It's a sell according to the model. Simply Wall Street is a lot lower than me. They're at $12 a share, so they're saying the stock is really overvalued. This is the stock price the last 5 years. The stock was doing really well from 2016 to March 2020. Then it dropped a lot like everything else. And it looks like the stock price came up almost to where it was in March. They seem to raise their dividend each year from 9 cents up to 13 cents a share. And to calculate the dividend payment, you could just multiply the last dividend payment by 4, take that number, and divide by the stock price. So they pay a 1.25% dividend yield. They pay out 111% of their net income and 24% of their free cash flow. The reason they pay out more than 100% of their net income was due to that large asset impairment that brought down their net income in 2020. They have a beta of 1.32, so the stock moves a little more than the market. The stock has gone up 4% in the past 52 weeks, while the S&P 500 went up 17% in the same time frame. The 52-week low was 22, the high was 44, and the stock is trading above its 50-day and 200-day moving average. About 2.5 million shares are traded each day on this stock. Of the 1.5 billion shares outstanding, 1.35 billion are on float, 69% are held by institutions, and under 1% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd be at $38,000 today. That's an annual return of 14%. That's a really good return. The biggest shareholder is Brookfield Public Securities that owns 8%. The CEO of the company, James Flatt, owns 4%, then RBC, then BMO, then Principal Global Investors. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 88.8, so investors are paying $89 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.0. They have a really good price to sales ratio. Price to book is stock price over book value per share. They're at 1.8. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $36 billion of equity, negative $3.5 billion of tangible equity, since they have $39 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can just cover their interest payments. ROE is net income over equity. They have a low ROE at 2%. Current ratio is current assets over current liabilities. They can cover 90% of their current liabilities with their current assets. And their current assets are $9.9 billion of cash, $25 billion of receivables, and $10 billion of inventory. They seem to be undercapitalized. If they generate $3 billion of cash flow in 2021, they're going to be short because they have negative $8 billion of working capital plus an $800 million dividend payment. So they're going to be short about $5.5 billion. The best way to look at ratios to compare them to similar companies, I've done videos on Atlas Corp, BlackRock, and 180 Degree Capital, all in the same industry as BAM. And if BAM has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're doing worse in PE because they had a low net income in 2020 due to that large asset impairment. They're doing much better in price to sales. They're doing a little worse in price to book, a lot worse in current ratio. They have a bad ROE, the lowest of the group. They're the highest in debt, but they're about 50% higher in market cap than the average. And they do pay a dividend lower than average, but at least they do pay a dividend. So to summarize, I have them trading at a 16% premium, but this is a pretty big company. It's been around over 100 years, so I don't think there's too much risk of them going anywhere. And they still seem to be putting up pretty solid numbers. I rank their free cash flow 7 out of 10, I rank their revenue 7 out of 10, and I rank their ratios 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.